Welcome to the Insider's Insight podcast, where we share with you the thoughts of the individuals who are working for projects that are changing the world. Thank you to our sponsor, Creditcoin, the building blocks of trust. For more details, please visit the show notes below. Welcome to OffChain Presents Insider's Insight. Today, I have a very good friend of mine, Wawrdog, who you may know from Twitter, and he's going to share some insights on today's current market situations. But before we begin, Wawrdog, why don't you just share with our audience your background into crypto and how you got into it?
Thanks, Sean. Yeah, good to be here, guys. I know we've been talking about doing this for a while, so it's good to finally get it underway. My crypto journey, it started in 2016. So I've been around the traps for quite a while now. Previously, I'd focused my trading and investing in like forex and commodities and some equity stuff. However, the interest of blockchain technology brought me to this space pretty quickly, and as any trader will tell you, volatile markets are much more attractive than some of the traditional stuff we're volatile. So that's initially what got me over. The innovation around blockchain technology took me down the rabbit hole, as I'm sure it did for most of us. So I guess that journey started off with just a purely investment based in trading, which then ended up in mid 2017 taking me into the venture space. And I started a small venture capital firm. They're supporting like early Web3 startups, some more successful protocols that are still operating today. It's really good that we had that support, but that was my core focus for the first few years up until 2021, where it started to get heavily congested in the VC space. And it was really, it became super competitive, and there wasn't a whole lot of value being added around the board. It was really just like a competition for branding and money and that kind of thing, and we kind of bowed out of that. In the interim, I joined a hedge fund firm operating in the digital asset space. I joined them, I think, 18 months ago. So I was managing primarily market neutral liquidity provision, DeFi. At the peak, that fund was sitting at 250 million in my portfolio, with the overall fund sitting just under $500 million. So I'm still managing that today. I continue to managing it. It's not exactly an easy task in these markets, as most people will realize. The contagion effect that's rippled through DeFi specifically has been fairly problematic. That's where my core focus is at the moment. So primarily a capital manager in the DeFi space.
How transferable were the skills from your FX and commodities days to the crypto days? And did you make the same amount of money when you were just trading those other markets? Or was there just something fundamentally different about the crypto markets that forced you to jump ship?
Yeah, nowhere near the same money. I'll tell you that right now. It's a much easier market to capitalize. There's a lot of nuances in crypto.
Why is it easier? Why is it easier? Is it just the inefficiencies?
There's a lot of inefficiencies, yeah. But there's also the way that you harvest alpha in this market. The inefficiencies, don't get me wrong, are enormous, and there's still a lot of opportunity there because not a lot of traditional money has moved in here, and it's still fairly nascent, right? In a lot of those kind of niche areas, but the ability to understand this tech and understand like the flywheel economics is something that is unique to crypto. And managing those flywheels in illiquid market can account for some exponential upside, right? And it's much harder to quantify than it is in traditional markets because there's not like a set model, right? Whereas commodities and equity market, there's a lot of parallels you can draw to what happens like with a token or the tokenomics, etc. There's a lot of nuances that aren't accounted for. That's a lot of what I spent 2018 doing is building an investment model around tokenomics and flywheels. There's a big focus around utility in that year, like 2018. A lot of people were focused on utility and cash flow models. And it was a bit more relatable for traditional markets, but it still had a lot of those nuances that enabled someone with the ability to extrapolate out an economic flywheel to give a reasonable forecast of a token of the price. So I think it's just because there's not a lot of models built out for this, so the space is still fairly fluid in the way that people interpret value and how someone interprets how a particular token model may play out in regards to price action.
Why did you not work in TradFi? Because you sound like you've always had an interest in markets, and it's a little bit strange that you've only done it on the side, but you're like so good at it, dude.
Yeah, thanks, man. It's funny, like, because I find it so enjoyable. I guess, like, I have seen a lot of people say, like, I won't, like, dox myself too much, but I, like, was fairly, influential in, like, fitness community stuff, early days of Instagram and that kind of thing, but I never took on, like, the personal training side of things, so I never really wanted to do it because it took the fun out of it, and that's not why I did it, right? And I always had the same kind of view on financial markets, like, I never really necessarily wanted to go full time in finance because I really enjoy doing it in my spare time. That probably sounds weird, but like it was more like of an enjoyable hobby to me. I didn't want to go in. It just so happens that I found a team of people that I was confident that wouldn't take the enjoyment out of it, and that's where I am today. But that's really the primary reason. Right? I didn't want to cross the worlds over. Sounds odd to say that like finance is your downtime, and it's super boring to so many people. But it's like I love the game theory, and I find it super enjoyable. So it was really just wanting to like isolate my professional career and what I do for enjoyment away from each other.
I think I can relate to that because I used to work in TradFi. And I studied economics during undergrad and only went into TradFi because everyone else around me at my university were. And I also did my CFA, and I've always enjoyed the theoretical part of finance and trying to understand narratives and how investors think. But working in TradFi definitely killed my love for finance. And in fact, I basically took a sabbatical in 2017 because I just couldn't take it anymore. And it's really funny because now that I'm in crypto and that I've found crypto, I find myself going back into, trying to understand everything I learned whilst I was working in TradFi. Because it's actually really useful because the crypto industry is so in its infancy that everything that you've learned from TradFi, you can actually just bring it into the crypto space and make it more formal and probably, a bit more efficient. But, at the time when I was working for a TradFi company, I would have never thought this because, I just hated it so much.
I think it's one thing to say, like, if you take, like, the analogy of, let's say, solving a puzzle, for example, and if you are solving the puzzle in your spare time, you get enjoyment out of that, it's a good hobby, right? And it's challenging, and you test your limitations on things, and it forces you to understand, but it's an enjoyable experience, right? But if you introduce a stopwatch into the puzzle, then all of a sudden it's completely different, right? Like, the incentive design is different, there's pressure, there's an expectation, that forces you to kind of execute diligently with the time you have. And I think that correlates well to if you're doing it for a job, right? And if you're in trad markets and you have that, obviously there's a lot of external pressure from investors and partners, especially in that business, that are an overlay that kind of take the fun of the puzzle away, because there is all those externalities that typically if you're doing it for enjoyment, you don't have there, right? So it's hard to enjoy that kind of journey of discovery and philosophy around economics and what this new technology means on. So I think that's probably a part of that, how that journey is.
Well, let's start getting into the meat of the podcast. What is your outlook on the markets? I mean, as of this recording, tomorrow's the merge. Well, it should be tomorrow. Do you expect any significant impact on prices post-merge?
Yeah, I guess my view from I've been very much risk off since December last year. Just another key indicator flagged on the macro side for me that I wasn't comfortable with continuing to with any direction. And that's like for my own personal investment. It's not the fund that I manage is always goes neutral. For that reason, I don't have much exposure in the market. I know we touch base now and then, Sean, around where I'm seeing markets going. I really struggle with the ability for the narrative to outpace macro at the moment. I think this week was probably the worst possible week that the merge could have been in place. Because we always had a CPI print, right, looming. So I feel like the numbers that have dropped in the last 24 hours have significantly dampened the ability for some price action leading up to the merge. And we've seen that reflect today, actually, in the last 24 hours. But it was always like this week is stacked with things that are happening, right? Like a big macro week, and a huge crypto week. And that's things, in order to get maximum value extraction, planning them around in the same week, vision is problematic at best. Like in traditional markets, I would never trade events. Just didn't like the uncertainty. And it messes with a bunch of models. So I always I tended to stay away from events, and this is kind of similar. I think the merge itself, obviously, the economic benefits for the network are fantastic. I'm a massive ETH supporter, and I don't, obviously it's not going anywhere. and the merge is fantastic for those operations and what it means moving forward. And obviously there's a lot of ESG pressure that's coming on the crypto markets, and it alleviates a ton of that. So it's always good to like smooth out that regulatory side for a clear path for the development to push forward. As far as additional price action, once it happens, in my experience, 6 years of crypto, it's rare to see an event have positive price action immediately post. I think even if you reflect to halvenings, for example, it's not like the price doesn't pump the day the halvening happens, right? We have a period of consolidation, and then there's a network effect that happens based on the new issuance rate, and it takes off. So long term, fantastically bullish on the economic design and incentive design for Ethereum. I think the core dev team has done such a great job in getting us to this position, and I've no doubt that this is the way forward, and I think it is the most scalable and efficient way forward, efficient from a number of different factors that we can dive into. But I don't think any immediate price action that is substantial will follow that can outweigh the current macro climate.
What do you think about a possible POW chain forking off?
I've been following I code a fair bit as well in my spare time. And I've been following along closely with the developments of the client side on ETH, and I've been fairly disappointed with the execution. If I'm honest, I think there's already a number of whole Ethereum ecosystem that have said that they publicly that they won't be supporting, which creates some challenges for that to execute well. DeFi is tough with that chain link. That's probably the elephant in the room. I would have expected a lot of the GitHub to be much further along in development than what it is today. Although yesterday, I believe the ETH team put out a statement that said that they'll be the actual fork will be X amount of blocks ahead of the actual merge, so it will be post merge, which will buy them a little bit of extra time to get stuff together. But there's even like contention over the chain IDs and that not being updated in the GitHub, and then sharing one with the hash. The smart Bitcoin Cash chain and stuff. It makes it like it doesn't really show a high level of diligence around execution, which is really needed to sustain this kind of thing. I feel like that value accrual will probably, for those people that are passionate enough about proof of work, will flow to Ethereum Classic, and we'll see like a richer development there. I can't see personally a long-term thesis where ETH becomes something, given but the social layer of Ethereum is, in my opinion, one of its strongest points. And if you take away the social layer of Ethereum, it might as well just be a regular EVM fork, though, right? Like, why? What's the value proposition, really? Other than a commitment to the proof of work, but Ethereum Classic has that, has that aspect already. So I'm not sure where it fits in the overall picture for longevity. If it does get off the ground and does launch, and there's enough movement around it, it will be a little bit chaotic, no doubt. And those kind of events are always interesting to navigate in this space, especially from those people that are ahead of the curve. Typically, a few people that have really proficient execution in these matters that profit the most. Look at someone like some of the lead engineers behind some of the MEV protocols that happen on mainnet now. And those are the type of players that I expect to profit greatly from that fork and extracting the maximum value in a short period of time. But I think from the average retail investor, probably going to be a tough one to navigate to realize anything.
I like the unbiased take on the fork, because in my personal opinion, I don't think it's going to happen. If it does happen, it's going to be worth nothing. And I just don't think they're going to have enough people to rally behind it. And my advice to miners, and this is not financial advice, but just like what you said, I think you should just support ETH Classic. I just don't see the point of an ETH POW chain.
Yeah, that really, I think it's like, digital asset space is one of, there's a lot of opportunity for momentum and for value extraction. And I think at the right place and the right time, there'd be enough incentive to benefit a very few amount of people if they can get the momentum behind it. But it's such a social confirmation game here. And if you don't have that social layer supporting for whatever means it happens to be, whether it's got big VC backers like some of the other competitive chains to Ethereum, I'm not sure where the support comes from. It's a tough one, right?
Definitely. So do you think that we're basically range bound from now until, say, the next halving to about maybe like ETH mid 3 figures to 2,000, and maybe Bitcoin in like the mid teens? I mean, maybe the mid teens is the the lowest would go to, but like in the 20Ks. Do you think that's what you're seeing at the moment? Crab markets?
Look, if you jump on my Twitter, you'll see like the charting that I forecasted in December to actually range in this spot right here that we're in now, in my little accumulation box. That was before a lot of macroeconomic stuff did change, so my forecast has changed a fair bit since then. That initial forecast in December was predicated without the issues we're having in Eastern Europe at the moment, impacting the supply chain from the inflationary standpoint of the CPI is now underpinned by a supply problem and not a debasement problem that we were having previous to everything happening with the energy crisis. So that kind of stuff shifted a little bit. I think like this, like high level 20K Bitcoin is a good price, right? Because I say this to people that are looking to enter the markets, etc. When they see an opportunity, it all depends on your time horizon, right? Like if you're looking to realize price accrual from Bitcoin right now and extract some profits from the price action in a short-term time frame, if you're looking like 1 to 3 months, you're probably not in a great spot to do it here. It just doesn't really add up. But if you're looking to invest in Bitcoin for the next 5 years or the next 4 years, 20K, 15K, probably doesn't really matter. That deviation in price isn't going to make a difference to like the end game for you. And if that is what the time horizon you're looking at, like if you bought a bunch of Bitcoin now, say you bought a Bitcoin and said, I'm not going to look at this for 4 years, you're not going to care if you didn't get it at 15K, right? But if you're looking at these charts every day and you can't stomach a drawdown of like another 25 to, 35% from this point here, then that's a different approach. As far as how low we do go, I don't see 12K out of the picture for Bitcoin. That's where I see like the next decent level of support, like a 10 to 12K range. Historically, I've got a working thesis around the monetary supply from 2020 as it correlates to core equities and stuff that seem to play out in traditional markets that I would expect to parallel in crypto as well. It is difficult to think of what the catalyst is to draw it down, but there's any number of things at any time. Right? There's a number of like key global issues at the moment that markets react very violently to, and the last 24 hours are a really good example. It was only a slight miss, right, on the forecasting of the CPI. But I think it's interesting that the markets are saying that it wasn't expected. However, I would not be surprised to see those drawdowns. That I like a crab to a breakdown and then potentially a retracement back to mean and then cruise through to the next halving. But there's a number of other key catalysts, right? Like you go down the economics of the merge, and how that plays into like supply demand curves, because that is a super interesting one. So it may over the next few months post merge start to gain that traction on the new economic model that drives its appreciation like outside of its correlation to Bitcoin. And then potentially lead alts, which would be different to what we typically see after a retracement. We usually have Bitcoin lead the market back up, and the new economic model and ETH poses a different stage. So there's a number of moving parts, right? And that's the hardest thing to forecast out, not only in crypto, but macroeconomically as well. But I think for the long term, these prices are a good DCA spot in my opinion. But the potential for downside is certainly still there. We're definitely not out of the wood. I can't imagine anyone saying that with confidence.
What I'm wondering right now is, are the same alts that led the last bull market are going to be the same ones that lead this one? So we're looking at Solana, BNB, Avalanche, Phantom to some extent. I realized that in the previous bull cycles, apart from maybe Tron, because, you have to say what Justin has done is pretty remarkable in terms of, making sure that Tron has super high TVL despite not having that many dApps on. You look at the other projects, your Zilicas, your Neos, your Icon, and what about the other EVM chains, your Tezos and your EOS? They're nowhere to be found. They still rank quite highly on CoinGecko, but in terms of height, in terms of people talking about development on that chain, they're not there. So I just wonder if, the chains from this cycle will still be there. I have a feeling they will be. I just think that the space right now is so different to the space that came before it. And I can't really see new mainnets, coming up and actually making a dent. I know Aptos and Syria, they have got a lot of hype right now, and previously Near did as well. But, I just don't see it, to be honest.
Yeah, you're right, particularly in the sense that in 2017, there was no DeFi, right? There was nothing to do on chain. Like, if the price action was literally all you could do, you couldn't try to harvest a lot from like operating on chain or trying to do something nuanced or, liquidity farm between two protocols or arbitrage between bridges. So there's a lot more to do. So I don't think, and that activity translates to fees, which translate to some value accrual in the chains, throughout a few of the chains. But that kind of, those mechanics weren't really present in 2017, which I think led to a lot of those, challenges or those things that are really taking off. Like the new emergents in the market are always going to be, somewhat like, particularly L1s, like, is how people are valuing, projects in space right now is they'll benchmark them against a successful protocol. Say, if we get 50% of the size of Ethereum, this is a TVL, and therefore this is our value, which is a bit of it's a bit of a false equivalency, because you're not comparing social layers, network effect, time in production, uptime, all those kind of things don't come into those models ever. For all the decks that I've looked at, that's not anything that's really ever really considered. A lot of the adoption is pushed by grants, and the chain is only really like, as far as adoption and transaction throughput goes, that kind of stuff is very much predicated on devs, right? And a lot of that funding comes from what they're raising in those seed rounds early. You'll see with Sui and Aptos always had quite big seed rounds in a market that was very bullish and people were happy to allocate liquidity. So no doubt the reward liquidity mining programs will attract developers to the space, but whether they sustain longevity is another story. That is, like, I guess the L1 narrative from the last few years was around that, and it was very much fueled by liquidity mining and that mercenary liquidity moving around different chains to capture value, and protocols supporting developers with grants, keep them active. And I think that's always going to be like one of the key indicators of success is how sticky the ecosystem is once the rewards dry up. And you'll see that like Polygon really led that incentive design in the last run, and development has really dried up there and shifted to not on the core team of Polygon is super far ahead of their development. That's not what I mean as far as like external developers building applications on the chain is going to bring a new market entrant sort of into participating in that network is very thin compared to where you're seeing the incentives lie everywhere else, and that's literally just like the base incentives, right? So I think like those emerging chains like Sui and Aptos they'll get some traction. But whether it's transient is the stuff that we need to flesh out over time, and whether they can execute and look after their environment well enough to support it. So hopefully that gives you my perspective on that side of things.
Just lastly, before we move on to the final part of the podcast, I'm been trying to figure out my long-term thesis on crypto to see how the space is going to develop. And I think there are a few areas where I'm super interested in. I think the first area is I think that traditional financial instruments will get moved on to be supported by blockchain officially, because right now if you want to buy or sell a stock, you need to wait for the markets to open and close, and they don't trade for 24 hours, and it's just ridiculous, right? I mean, crypto trades 24/7, and none of these other markets do, because the technology is just not there for those markets to trade 24/7. And on crypto rails, they are. So I reckon that's going to be a major driver in the adoption of crypto. The second thing is, I believe that we're going to start seeing capitalism get revamped. Because the problem with equities and shares is that the value accrual only goes towards them. Whereas if you're a stakeholder, you don't get any of the upside. Whereas with crypto, I think the economics you can design behind the token means that you can give all stakeholders a benefit from supporting the project. And therefore, it just becomes a much fairer place to in terms of its distribution of value. It's a bit fairer. And I think that's going to be good for capitalism and therefore good for blockchain. And then finally, we had a podcast with Sam, who is a 24-year-old founder of Zebek, which is a payment streaming protocol built on top of Solana. But I think they're looking to go multi-chain. And he said something really interesting, which is that the way he sees the next development of crypto is that he believes that traditional Web 2 infrastructure needs to be moved onto crypto rails, because that's going to bring increasing efficiencies upon members who are sharing development in the space, because they can then just tack on the combined development of whatever database instead of building their own database. And that's going to fill up the block space on these blockchains, which is ultimately needed to get, the value of these blockchains to grow. I just wanted to know, what are your thoughts about how we're going to see value getting accrued in the blockchain space? And do you agree with my thesis, or do you think there are other aspects to look out for?
Yeah, I do agree with a number of the points you made. I think like on the second point, as far as the ability to enhance like the benefits for investors from like traditional equity models, I think that's a hard breakaway. Simply because like, I say this to a lot of people when we talk about DeFi and what's the difference between traditional finance and decentralized finance, and it's not always like all those designs that we're building now, they're not new, right? All these products that are being built, there's some unique stuff like Perp, of course, like a new product built by this market due to like the time, the traders, like the 24-hour time that we have to trade it like every single day in these products. The Perps are invented off the back of that requirement, but like we're really just recreating stuff on Fast Forward, and we're like really, breaking things on Fast Forward that have got a parallel to traditional finance. I think you'll still see, even in like DeFi now and in crypto, you see some economic models that mirror a lot more like equities, and they're built that way in order to like prioritize the future development of the protocol or what you have in parallel, or the business company ahead of the investors, to ensure like proliferation of what they're doing. So I think that is like, I think it's a fine line where people are trying to find the right value accrual. Even, Uniswap and the fee sharing, obviously, there's some regulatory factors that come into that equation as well, but that protocol doesn't distribute fees, right, to any LPs, and it's still the biggest debt. So it's I agree with what you're saying, but I think it's like we're just really trying to figure out what is the most optimal strategy for doing that. I think that kind of stuff will evolve over time, and hopefully, like the equity stuff will follow, but I think there'll always be space for how some of those traditional equities are set up right now. Like Amazon's a good example right now. Like it's obviously a huge business. It doesn't pay out dividend, right? So that really doesn't, as the grand scheme of things and what the measure of success is for that business, isn't predicated on sharing value to investors like that. So I think there's some cases for and against for like taking on more of the distributor model, that side of things. On the final point around the bringing those payment rails and integrating across, I think that does happen, but I don't think it happens the way that most people think it's going to play out. I think a lot of this, like the institutional adoption, happens on private chains that are KYC, right? I know there's a number of the L1s at the moment that are in discussions with launching KYC chains strictly for institutional capital. And that really segments out a lot of the composability that we love in DeFi, right? But it's, when you think like all the movements in the regulatory space, particularly around Tornado Cash and how those sanctions are applying to wallet addresses and the risk that poses to someone that's not necessarily happy with someone's ability to exclude them from a system like that crossover between traditional finance and what we typically would expect to see in DeFi at the moment is a difficult bridge. So I think there's still a ton of work to be done there. I think like those kind of activities, like the traditional money, any kind of reasonable size that you can draw a parallel to traditional markets, will be on chains that have no risk of crossing over with assets or with any users in a permissionless way that is not already pre-programmed. It would just be like, I can't see like a world where any responsible traditional finance regulatory body thinks that's okay to be deposited in the compound pool with a whole heap of size from, like, let's say a bank that's commingling in assets that are sanctioned from somewhere, right? From sanctioned for XYZ because they engaged in Y protocol. I think it's just more likely and like a clearer path to adoption or like those kind of on-chain benefits you spoke about, particularly like around settlement and the unique operational functions of decentralized finance that can easily be captured through them putting up these different moats around ensuring regulatory compliance. So I think that's the most likely path forward. Definitely not my optimal. I prefer liquidity being curved. personally, but I don't think that's going to happen. I just think it's a big bridge to cross when there's a reasonable solution from the regulatory side to do that. So I think the money does come in. I just don't think it comes in a way that most people are expecting it to come in, have access to and interact with in any substantial way without KYC, of course, and AML and following those guidelines.
Perfect. Okay, so before we get you to leave, I would just want to know, because this is called the OffChain podcast, what do you do in your off time? So, I mean, I guess previously it would be trading markets. You do that professionally now. So what exactly do you do when you're not working?
Not working is funny in 24-hour markets, mate. So I'm not sure that that happens too often. Honestly, mate, when I'm not trading or like monitoring my portfolio and migrating positions, I'm probably coding something. I'm personally building a few different DeFi protocols and with some partners as well. Some decentralized finance focused. I do some advisory for a few different protocols as well in the GameFi space. And also working on my own GameFi project as well. Not for like financial side, but just really enjoyment side of things. So I spend a lot of my spare time learning more about this stuff to enhance those. But in my actual downtime, I'll probably be at the beach having a surf, mate. That's my morning ritual typically, is go out and take in the sunrise on the board and catch a few waves and come back and do the finance thing through the day and on, mate. So, but honestly, mate, probably 18 hours of my day is dedicated to these markets now. So, but not out of like the necessity too, but simply because I do just love the space.
Dude, so you still find time to surf, even though you're basically glued to your screen?
It's the only downtime you can have, mate. Set the stop loss and just get in the water. Mate, you gotta have that downtime somewhere, but like that time I have is so minimal. Like I try to set like an hour or two aside every day, and then there's like through one means or the other working in the
What about your sleep?
Don't sleep, bro. Rarely. Yeah.
That is interesting.
I sleep more now than what I did a year ago, I'll tell you that. It's interesting, mate. The time zone that I'm in is not super favorable to a lot of on-chain activity. So that does create some challenges and messes up the sleep schedule a little bit. Like statistically, protocol exploits happen in like based on my time zone will happen at 2 to 3 a.m. in the morning. There's a weird concentration time around a specific spot for DeFi protocol exploits. So I've got a little bit of like built prediction models that are based on all that historical data and aggregate these certain data points that I use for investing. And I've got a little bit of PTSD from my own data, I think. So I'm like waking up at 2 to 3 a.m. check those kind of markets. It's all worthwhile, mate. I wouldn't do it if I didn't enjoy it.
Yeah, dude. We need to do a live session with OffChain and you could just show off some slides, because I think you're so ahead in the game thinking about this shit. I haven't heard anybody building models and having such a deep insight on and such a complete insight on how the markets are. We got to do this again. Hopefully maybe in 3 months or 4 months time after the merge has happened and we can get a feel about where the markets are for the new year. I think that would be really excellent. And maybe we do it live and you have some slides to show if you'd like to do that, because that would be super helpful too.
Yeah, sure, mate. No worries. Happy to. I've got a number of different models that I think you have a look at. Yeah, mate. But more than happy to jump on. I've enjoyed the chat today.
Awesome. Thank you so much, man. It's been a pleasure as always. I tell people who are close to me that you're like my unofficial master when it comes to these markets. I've learned so much since getting to know you, and it's always been such an honor of mine to have known you, because I just think that the insights you're bringing to the game are second to none, man. So thank you so much.
Oh, my pleasure, mate. Always enjoy our chat. Always keen. Okay.
All right. That's all we have for this episode. Thank you for listening, and we'll see you all next episode. Bye, guys. The Insider's Insight podcast is meant for informational purposes only and should not be considered as financial or investment advice. Nothing expressed in this podcast should be construed as a solicitation, recommendation, endorsement, or offer to buy or sell any financial products. Information expressed by the host or guest of this podcast does not necessarily reflect any views of our sponsors.